there's either going to be a chaotic collapse, in which case gold's going to do really well. Gold and Bitcoin are really the only assets that we see that do well regardless of whether the central banks stave it off or they don't.
Please join us for our next live stream, Sunday, May 17th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, May 17th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or you have not already done so, please do subscribe, click on the bell to be notified of new updates, and give us a thumbs up if you like what we do. We really do appreciate your support. Luke Gromen, founder of Forest for the Trees, or FFTT LLC, an investment research firm that aggregates a variety of publicly available data points in an unconventional manner to identify developing investment trends, joins us once again here today on SBTV. Luke is also the author of the Mr. X Interviews, World Views of a Fictional U.S. Sovereign Creditor, a fascinating read, which we will discuss in this conversation with Luke. It's time to saddle up and silver up for Luke Gromen. Luke, welcome back to SBTV. How are you doing?
I'm doing great. How are you today, Patrick? Thanks for having me back on. I'm excited to be here.
I'm doing great as well, and thank you for coming back. It's great to have you on once again. Your tweets, I mean, a lot of us, we've been watching your tweets, and we said, hey, geez, we got to try and get Luke back on here again. So we're glad you had time for us. So I guess we'll start with, last time we spoke, last year sometime, the world has really, really changed since then. A lot of things have happened. How are you coping in the midst of these lockdowns during this pandemic?
For me, it's been a bit of a real test in terms of just being present and focusing on the process. In terms of professionally, not a whole ton has changed. I work out of my house, so that's not a huge change. I worked out of my house a lot in the past, so that's not a big difference. But I think for me, some of the harder things have been around. We were just talking about my oldest son. He's graduating from high school this year, so cruise season was canceled. Commencement might be canceled. Sort of all of these rituals around senior year of high school, prom, etc., have been canceled. And so a lot of mental work around that. And in terms of professionally, I think just focusing on the process of trying to help clients where, look, none of us can control what's happening. None of us can control the outcome. We don't know the outcome. And so what we really try to focus on, myself and FFTT, is just the process. What are we learning? What does it possibly mean? Share it with clients, help clients try to understand and help our clients build a mosaic up in terms of the potential range of outcomes that could occur as a result of what's happening.
Yeah. I mean, were you shocked at all by the speed of how, for the first time in history, most of the world is on a lockdown?
I am. I was. It caught the COVID caught us by surprise. It was. We came out of January a little bit just tactically cautious, simply as a result of what the Fed's balance sheet was doing back then, which was that it had stopped growing, and we thought that set up for a possible tactical pullback. Of course, nothing, no idea what followed. Of course, we did not expect that at all, and the speed at which it spread, the speed at which it hit. And then, like you said, the unprecedented nature of which at which they locked the world down, it made for a completely different set of outcomes. Unexpected set of outcomes.
Yeah, we've been seeing reports coming out about rising unemployment due to business closures and a severe reduction in economic activity. Over here in Singapore, we haven't really felt it that bad yet, or seen the damage or felt it in the real economy that significantly yet. But on your end, how's the real damage to the real economy where you live, or what have you heard from your friends about the situation in the U.S.?
I think you can see it in the U.S. industrial indices and the U.S. service the industrial indices are one side, and they've been worse than '08 in a number of different metrics, new orders, activity. So it's been a collapse, and I think that's, I won't say it's to be expected in a severe recession. It is to be expected in a severe recession. So that's the thing that I think perhaps has made this downturn different, has been the similar collapse we've seen in terms of magnitude, in terms of the service indices, where the U.S. has become more of a service-based economy, and you've seen historically the service ISM has been not nearly as cyclical, and it's been very cyclical as a result of these mandated shutdowns, and that then is a real wild card in terms of the ripple effects, which I think we're only just starting to see in terms of who's paying rent to landlords, what's the commercial real estate side look like, mortgages, so on and so forth. And so it's tough. And the longer it goes on, we had this sort of initial burst of excitement about the government, payroll protection plans, basically paying businesses to keep people on payroll. And that money's sort of come and gone. And so now we're into this sort of no man's land of, is the next round of stimulus coming? Is there more coming from the government? Or are businesses going to have to amp up the closures? I just saw, as we were getting on this morning, GE's laying off a quarter of their entire global workforce, about 13,000 people. That's tied to weak airplane backlog cancellations as a result of the airline. So the further on we go from this, while we remain in this shutdown, it's unfortunately, given the leverage in the system, it's just going to keep getting worse and worse, and that's it makes it tough.
Yeah, getting worse and worse. Have we actually seen the worst yet in the economy, or what? How much worse do you think it's going to get, or what should we brace for?
That's the $64,000 question, right? I think it depends in no small part on how fast we open back up. I think it depends very much on how much the global central banks do, and in particular what the Fed does in terms of, for lack of a better word to oversimplify, pumping up asset prices. Because if they can pump up asset prices, they can create some demand, particularly on the other side of this when we start coming out of it. And so you can quickly paint how bad could it get? It could get catastrophic. I mean, we could see the disorderly collapse of the entire system. And it sounds apocalyptic, but it's really just math. When you look at, we've got 320% debt to GDP, and we take GDP down, whatever it's running down, 5, 10, 20, 30% in some cases. That debt can't get paid back. And once the debt starts going, starts defaulting one place, there's this daisy chain effect that it could really get catastrophic all the way up to the sovereign level. So that's the worst case scenario. I think central banks have stepped in, and I think in March in particular, when you saw what the Fed did, I think they were trying to communicate that we are going to take that right tail off the table, that we are not going to allow that to happen. And I think for some people that's intellectually offensive to hear, but the fact was the Fed grew their balance sheet at a $20 trillion annual rate for 6 weeks. And that's a very powerful message. They can do that. They took the dollar from 102.5 on the Dixie, 102.5 to 98.5 in a week. It was the fastest drop in the Dixie since 2009. And so that showed that, to me, that the Fed was drawing a line in the sand. We're going to try to take the most extreme right tail possibility risk off of this, and that we have the means, motive, and capability to do that. And so, to me, we have to start thinking more about, okay, what are the other possibilities from there? And so that is where I'm spending a lot of my time, is trying to figure out the pace of reopening, the pace of what the Fed and other central banks are doing, et cetera.
Yeah. Okay. I mean, speaking of the Fed, how much can the Fed actually do to remedy the situation with more money printing and continuing to grow its balance sheet?
I think the governor on the whole thing is really the dollar ultimately. Mechanically, there's no limit to what they can do. And I say that because when they create money, when they create dollars, they create both an asset and a liability at the same time. And so in theory, they could create dollars and buy up the entire world dollar for dollar, and it would all sit on their balance sheet. Now, that's just from the balance sheet accounting, debits and credits accounting of it. Excuse me. From a practical matter, there are political considerations, and then there's currency considerations. There's certain things that, according to Congress, they can't do at this point. That said, they've been able to work around some of those in terms of setting up special purpose vehicles for buying corporate debt and some junk debt and some ETFs, et cetera. So I think that they can do what they have to do to keep the financial system from collapsing on a nominal basis. But they can't really do anything about it on a real basis. They can't print passengers for airlines. They can't print pharmaceuticals to treat stuff. They can't print masks. And that's where this gets into, it's a little trickier than pretty much every other downturn in most traders' careers, is historically they have been financial market problems that can be papered over with enough brute force from the central banks. And they can do that again here on the financial side of things, but then they still can't address the real physical interruptions that are occurring. And that's where it starts to get into a different territory, this crisis, versus pretty much every other crisis, is certainly in my career, but I would say in the careers, of pretty much anybody under 70 or 80 years old.
We're seeing, and you mentioned it, where the Fed, excuse me, is buying corporate bonds, and but you got to wonder what are the implications. For instance, are the taxpayers going to be on the hook for all of this?
I don't think they will be. Ultimately, not directly. I think ultimately everyone's going to pay a little bit through higher inflation on the back end of this. I think that's ultimately where you'll see this. The Fed is not on the hook for any losses on the corporate purchases. As I understand it, Treasury is, and Treasury is, of course, the U.S. government. But when you have the Fed buying more than 100% of Treasury issuance, as they are this year, the lines start to get very blurry. And so I think ultimately I don't see a lot of risk to the taxpayers from the standpoint of nominal losses. But what I do see is a likelihood where I think we're seeing some asset inflation in the last month, of course, as the Fed has stepped in. But I think from a bigger picture standpoint, I think over the course of the next cycle, where this will be paid for, if you will, is inflation rates, broadly speaking.
Okay. And Luke, you've projected that the Fed's balance sheet could hit 10 trillion later this year around Christmas. 10 trillion, 15 trillion, 20 trillion. Is there a number where that much credit created will bring an end to the money printing game? Because otherwise it's kind of pointless to keep track of it if there's no net detrimental effect.
That's I think another $64,000 question. For me, it seems like we're in a situation where the Fed is effectively creating dollars to keep the dollar from rising. Basically, they're basically injecting dollar liquidity, keep the system together to keep the dollar from rising. And so, as long as that is the case, I don't think there's any negative effects. They're basically filling in a hole in the Eurodollar system, right? If you've got this Eurodollar system, the offshore dollar system. Rabobank a couple weeks ago estimated that system at $57 trillion. And so because we've had this giant decline in the economy, what the Fed's doing with this balance sheet growth is effectively filling in a hole. And so there's to your point, there's really it doesn't matter for the time being. Now, where it starts to matter, I think, is the longer this goes on, then in theory, the Fed, if it wants to prevent the system from collapsing in a disorderly manner via a chain of debt defaults, the Fed's going to have to bring greater and greater amounts of the global dollar-denominated debt outstanding onto its balance sheet, basically reserving that debt dollar for dollar. And so when you look at domestic dollar-denominated debt here in the U.S., let's call it $47 trillion. The euro-dollar system is estimated as much as $57 trillion. To me, where the $64,000 question is in terms of when this starts to matter is 47 trillion plus 57 trillion is 104 trillion. So that's, I would say, sort of a price target, if you will, of where the Fed's balance sheet should go. It should be a magnet for the Fed's balance sheet to go the longer the COVID crisis lasts. And at some point on that path, I think the bond market starts to say, hey, they're capping yields. They're going to take the balance sheet to 104 trillion if they have to. And maybe it's not inflationary now, but it's going to be at some point. They're just buying up all the debt. I'm going to move out of the bond. The bond market will try to squeeze into the equity market, into the gold market, into Bitcoin, into basically anything but bonds. And the bond market is the biggest of all these by far. And then I think it starts to matter, because at that point, you go from the Fed being able to manage the process to the Fed having big chunks of these bond markets sold to it. In other words, they have to buy a lot of the treasury market. And so then spreads on mortgage backs rise. Then they have to buy a lot of the mortgage back market. So then spreads on corporate rise. They have to buy that. Then spreads on junk rise. They have to buy that. And pretty soon, that doesn't happen linearly. That's not going to happen in a night. That's not how markets work. They go little by little, and then they go all at once. And so that all at once moment of realization where the bond market goes, wait, they're going to have to buy this all if this crisis keeps going and dragging on. And that to me is sort of the aha moment that I think it will start to matter. And the flip side of it is if at any point in time that they don't do enough money printing, that they don't inject enough dollar liquidity, you're going to have a big risk off. And that then creates its own set of problems, debt default risks, because if they lose control of that on the downside, that poses risks to sovereign debt around the world. And that's the bedrock of the system, and in particular the U.S. Treasury market. So they're walking a very narrow line. And so far they're doing a very nice job of it. But it's almost like a Jacob's ladder, right? Where the first rung is sort of so high, and then the second one's a little higher, and each successive rung of the ladder, the distance between the rungs spread. And so by the time you're up a bit, I climbed one of these at an obstacle course as a kid. You get 30 feet on the ground, and the next rung is 10 feet up above you or 8 feet above you. So you got to shimmy up the side and kind of hang on and hope you don't fall. And so that's the position they're in. So that's how I would think about that. That's how we're thinking about that at this point.
Okay. Yeah, you mentioned the U.S. dollar, and I understand that you believe the U.S. dollar will rise in the short term, perhaps a couple of years. Why would the dollar rise since the Fed's money spigot is turned on and displayed in full view to the world? Wouldn't the immediate effect of such QE-like actions weaken the dollar?
So I think it's a minor point of clarification, I would say, is when you look at this dollar demand, our view is that this dollar demand that we talk about absolutely exists. When you talk about the $47 trillion in domestic demand, and more importantly, this euro dollar demand, which is as much as $57 trillion, that creates this dollar demand, which absolutely will drive, all else equal, will drive the dollar higher, particularly when you see economic activity slow just a bit, and particularly when you get what we've had over the last couple of months. And so our view is that what the Fed's doing is effectively trying to keep a cap on the dollar, because if the dollar gets away from them, it creates this disorderly collapse as well. Because if you look at something else that is different in this crisis versus the past is that the U.S.'s net international investment position, NIIP, is negative 50% of U.S. GDP. And what that means is that foreigners own $40 trillion gross in U.S. assets, and the U.S. only owns $29 trillion in foreigners' assets. So this is very different than prior cycles. If you go back to 2008, for example, that NIIP number was about -8% going into the downturn. 2010, it was -2.5%. So from 2010 until now, we've gone from -2.5% to -50%. And in plain English, what this means is that the U.S. has had the recovery it's had relative to the rest of the world because we've basically hocked our family silver to pay for a giant party over the last 10 years. What it means in practical terms going forward as it relates to the dollar is that if the dollar gets too strong, it forces this dollar-denominated debt that has to be paid and forces foreigners to start selling this $40 trillion gross in U.S. dollar-denominated assets. And it touches off this death spiral, which in turn filters back into the U.S. economy because we are so heavily asset price driven. The U.S. economy can't grow unless asset prices are rising. And if our economy can't grow, then we can't pay our debt back, which it vortexes into the sovereign debt markets. And so for me, it's a very serious matter for the Fed to try to keep a lid on the dollar, to keep the dollar from rising and touching off this doom loop, effectively, this vortex of foreign selling of dollar assets to pay back dollar debt. And so that to me is what I think they're very focused on doing. And so it suggests that they're going to be able to grow their balance sheet much more than people think, just to keep a lid on the dollar for as long as things are, for as long as the COVID crisis is persisting. Again, I think the tipping point is unknowable ahead of time, but is there a level where the bond market more broadly says, okay, they're just going to buy it all. Let's just sell it to them and move into and prepare for the inevitable on the other side of this, which is once the Fed balance sheet gets to a certain level, and I think we've already seen, they're not going to be able to get out of that position. And at some point, we're going to come out of this crisis. You know, if the Fed's balance sheet's 10 trillion, 20 trillion, 30 trillion, there's no selling that. And if it starts to look like we're going to get out of this crisis, either the Fed's going to have to raise rates a lot and hurt those bonds, the bond market, which there'll be bond market selling, or they're not. And same thing. They're going to get eaten up with inflation on the other side as velocity picks up. So that's what I think is happening is basically they're trying to keep a lid on the dollar, thus far fairly successfully.
Something that is definitely in a crisis right now is oil. What happened with the price of oil, and how is it possible that it went negative? And what does a negative oil price even mean?
Yeah, it's interesting. After the day that happened, I asked my youngest son, I said, here, I got a number for you. I said, oil went to negative $37 a barrel today. What does that mean? And he looked at me, he said, I don't know. I said, well, good. That makes two of us. I think ultimately, there are two factors that drove that. And, you know, people that are deep in the weeds on the oil market will give you more detail on it. But from our view, I think it's two key things that drove it, which was the global drop in demand and a lack of global storage capabilities and our capacity as storage got filled up, and there was no place to store this stuff. And so, you know, one of the CFO of one of the biggest traders in the world told me 15 years ago, in commodities, the marginal ton prices the whole. And so the marginal ton of oil was priced, it had no place to go. You can't take delivery of it. You have no use for it. You have no place to store it. And so it was just get this barrel of oil off my hands. And so I think that was the first side of it. But I think the other equally large but less discussed point of it was a symptom of, I think, the degree of financialization of U.S. energy markets and U.S. oil market in particular, because in theory, you know, there was a finite contract roll period. There's too much oil. Oil can get negative. Okay, great. But negative 37, you know, that suggests, I think, a real degree of the leverage or the degree of financialization in U.S. energy markets that we've seen in other markets as well, gold, other types of derivatives. And, you know, it's a bit of an indictment of that market. And so, you know, we'll see what happens as a result of that. But I think those are the two factors that really drove that.
Okay, so if these low oil prices, if they stick around for a while, what impact would it have on the economy and for the average Joe?
I think for the average Joe in a normal economy, low prices are a pretty good thing. That said, that relationship that has historically persisted here in the U.S. that low oil prices are good, it sort of turned on its head over the last 10 years, of course, with the shale revolution here. And so we saw it in 2014 to 2016 when oil prices fell sharply. US ISM went negative and the economy really slowed down. There were some other factors happening, but the fact that we're now one of the world's biggest oil producers suggests that it's all else equal and negative for the U.S. economy, particularly on the industrial side and the ISM supply chain, the industrial supply chain. The other thing you get into too is the broader global balance of payments dynamic, which is also interesting. It creates increases the dollar shortage overseas, all else equal, in the short run. It creates pressure, fiscal pressure on Saudi, Russia, all these oil and commodity exporters, and so again, it creates more pressure that selling of dollar asset doom loop we were talking about to try to repay dollar denominated debt that we were talking about a minute ago. The low oil price acts as an accelerant to that. When you look, the Saudis sold I think $27 billion in FX reserves in March, and that's 350 billion annual pace, 325 billion annual pace, whatever the number is. That would be 70% of their reserves roughly in a single year. So then you get into currency crises. So and the flip side is it turns back around on the Fed of if the Saudis are selling treasuries and the Russians are selling treasuries and all commodity producers are selling treasuries and all these dollar denominated assets are selling to try to raise dollars, who's buying? And the answer is there's only one buyer. It's the Fed. And so that is, to me, the low oil prices just sort of enforcing this game of lots of sellers of dollar assets to try to raise dollars to pay down dollar denominated debt, and only one buyer being the Fed.
And this low oil prices, it should affect tax revenues, and it'll likely have a domino effect on governments like the southern European countries that we already know that are not doing fiscally well outside of this pandemic or with the onset of the pandemic.
No, I think that's right, and that is going to be, I think, when we let off talking about some of the second and third derivative impacts. Whether it's Southern European countries that started off in a difficult position, and now you have the costs associated with this. Here in the United States, there's a number of different states that started off in a very difficult position fiscally that are now in sort of the sort of in the same position as Greece and Italy, Illinois and New Jersey and maybe Connecticut, where you've got these tax holes. I mean, even states that were doing relatively well, Florida's not structured for a shutdown of the economy. I hadn't realized this. Someone pointed it out to me, but they have no state income tax, so they fund themselves on tourism and they fund themselves on and there's no tourism. So you've seen a big apparently a big upsurge in unemployment, but the unemployment benefits have been very slow in coming. It puts a lot of pressure on the budget because there's no money coming in. So there's this. One of the big second derivative impacts, I think, are what's going to happen with fiscal budgets around the world. And then it all factors back also with what's happened with stocks, with the pension. And here in the United States, at least, you've got public pensions that are managed, police, fire, etc. What just happened in equities, it puts more fiscal pressure on it. And the states here have to run a balanced budget, so they cannot run deficits. And so it implies either we need a very big, very rapid recovery, or we need to really start slashing services at the state and local level. And when you start looking at some of these older states, already a very big portion of their budgets were tied to just paying out pensions to police, fire, public workers that already retired. So now it becomes a political problem because you either cut their benefits or you cut your current services down to a skeleton crew, which gets into, like I said, a political problem, potential social problems. So it sets up as we move through the balance of this year, the potential that a second and third derivative of this crisis is happening at, touched off by what is effectively fiscal crises in the fiscal states, whether they're U.S. states, U.S. municipalities, Southern Europe, et cetera, that came into this crisis in bad shape to start.
Look, would you agree that this virus is somewhat like as Jim Records famously explained it, somewhat like a snowflake that triggers an avalanche and has risks increased dramatically globally given the already highly indebted global economy?
I agree with that 100%. I think this was the entire system was to paraphrase. I don't know if somebody else, but basically a bubble looking for a pin or a bug looking for a windshield. When you're running leverage as high as this system was running leverage, and I think it's important too. 2000 we had a stock bubble. It popped. And we kicked the stock bubble up to the banking system by creating a housing bubble. And then it popped, and we kicked that problem upstairs to the sovereign level by basically increasing sovereign debt around the world and to very high levels, highest since World War II. And now we've had this pop. There's nowhere to kick this upstairs to. Well, there is. They have to kick it upstairs to the currency, basically. The central banks have to basically create whatever currency is needed. Otherwise, we have our first global. I think effectively what we're seeing is the first global sovereign debt bubble in 100 years was burst by COVID. And there's two ways. There's really only two ways out of this. There's a great white paper put together by Carmen Reinhart and Belen Sabrancia for the IMF. It was published in 2015, I think, and it was called The Liquidation of Government Debt. And it's a roadmap. It's basically in the next crisis, we've got all this government debt, and in the next crisis, we're going to cap yields and we're going to inflate and we're going to, basically government bondholders are going to lose a lot of money on a real basis, but not a dime on a nominal basis. And there's this one chart in particular in there that shows going back 120 years, the public debt to GDP ratios. And it shows it for advanced economies and developing economies. And without fail, 100% of the time for the past 120 years, these things work out only one of two ways. Either the debt's restructured or defaulted on, or inflation, monetary financial repression, and a few hyperinflations. And so they are either going to restructure the sovereign debt, and the reality is, given that the problem is more in the West than it in developing markets than it is in developing economies on the sovereign side, the odds, and given that that underlying sovereign debt is such a critical underpinning for the financial systems broadly, the odds that they let it default or restructure are virtually nil, in my view. And so the central banks, and in particular the Fed, I think are cornered into having to provide whatever liquidity is needed. They are who is going to be kicked. This is going to be kicked upstairs to now that, like you said, the virus was the snowflake that triggered this avalanche.
Luke, you've compared on Twitter the impact from the collapse of Lehman, which had 800 billion balance sheet, with China, which has 40 trillion. How big a risk is the Chinese economy, and is it the greatest cause for concern right now?
It's a huge cause for concern, and that the relative sizes of those balance sheets, I think, are important and lost on a lot of folks. An $800 billion balance sheet at Lehman was enough to take the system to the brink, and we had less leverage then than we do now. And so when I hear people say, "Well, China could collapse," and it could. But that's the whole system's going to collapse about 5 minutes later. In terms of the where China stands now, you've seen some signs. Maybe they're coming out of this earlier, as you'd expect. They went into it earlier. They are in a very they have the same sort of debt problems that we have, maybe even larger. We'll see what comes of this. Ultimately, what appears to be happening is they're being forced by this COVID crisis is a hard divorce of sorts between the U.S. and China. And if that's the case, it creates it creates additional pressures on the Chinese economy. They are going to need to become much more internally consumption driven, much faster than maybe they had planned. And so for them to kind of come out of this is going to require them to increase stimulus. But of course, if you increase stimulus too much, that puts pressure on the yuan, and that is the trade-off there. And so they, like us, are I think walking a very, very narrow tightrope for the moment. And all of this depends on some sort of normalcy arriving relatively, sometime in the foreseeable future as it relates to economic growth more broadly.
We spoke to Thomas Mullinen recently, and he described the European banking system as tinder, waiting to be lit by a flame or lit a flame at any time. So Europe, the US, and China, the major economies, are all infected with this debt contagion. When this debt bomb explodes, will there be a region anywhere in the world that will be left standing or escape unscathed from this economic carnage?
So the short answer is I don't think there will be any region that escapes. I've equated the three, the United States, the European Union, and China as sort of three guys that are tied together with a very short rope, all running towards a cliff. And so it's a race to see who gets there first. And there will be a sort of a small consolation prize for being right about who it actually is. But it won't really matter because the other two will go over connected and moving at basically the exact same pace. And so to me, the way I've thought about it, of your question of is there a region that will be safe, or I think it would affect the whole world. To me, what it comes back to is it's why gold seems so clear. Gold and Bitcoin seem so clear as assets. Is I can't tell who's going to go over that cliff first, but I know it's looking increasingly likely now with the COVID crisis that at least one of them is going to go over that cliff. And once one goes, they all go. And I don't. The reason why I like gold so much and Bitcoin as well is I don't have to be right on the order. They're running neck and neck. I can just move assets into gold to Bitcoin, and that's to me where I think ultimately the safe haven is going to be. Because if we go back to what we talked about earlier, there's either going to be a chaotic collapse, in which case gold's going to do really well, or the central banks are basically going to have to buy in much of the global debt market, and gold should do really well too. And so gold and Bitcoin are really the only assets that we see that do well regardless of whether the central banks stave it off or they don't. And everything else has sort of binary outcomes. It either does well before but bad after a collapse, or it does poor before a collapse but really well after. Gold and Bitcoin don't really care the outcome. And so I like that positioning, and that's how I would answer that in terms of, is there an area? I don't know that there's any geopolitical or geographic region that would be able to. I think you'd have relative winners and losers. I think Russia, because of the sanctions we put on them over the last 10 years, they're already pretty autarkic in terms of their self-sufficiency. Maybe they would do it, but even then, oil demand would collapse. So everybody would sort of be loaded into this banking machine, in my view, geographically. And so it puts me to gold, Bitcoin as really the only winners in that kind of scenario.
Okay, so if there is let's say a new monetary system that has to come out of everything that's going on right now, and fiat starts to fall, you're seeing gold and Bitcoin as being able to move over into a new monetary system, or at least have a place in a new monetary system.
I think that's right. I think ultimately we're seeing signs of that new monetary system developing, basically, which is, since 1971, the dollar has been the reserve currency and the treasury has been the primary reserve asset. And that's created the system where we've gotten to today, where you have these massive imbalances. And ultimately, really since 2013, when you've seen global central banks stop buying treasuries and buy gold at the fastest pace in 50 years, I think that's been a hint of where this system is going, where they're basically separating the reserve currency from the reserve asset. And so the way we see the system going is out of evolution and out of necessity, is basically there's going to be a neutral settlement asset of imbalances around the world, and whether that's gold, whether it's Bitcoin, whether it's digital central bank, some sort of digital central bank script, ultimately that suggests neutral reserve assets should all rise against all fiat currencies. And I think that's we're seeing that happen. You're seeing it, for example, the gold just broke out against the SDR basket of currencies to new all-time highs. I think that's where this movie's going.
Okay, and in the context of what we've discussed so far, what is the most important thing that the world is not discussing enough at this moment?
The thing I think people are not discussing enough is that point we talked about earlier, which is as you look back over this within the context of we kicked the equity bubble up to the housing bubble and the banking system, and we kicked the banking and housing bubble up to the sovereign debt market. And now we had a sovereign debt bubble, and it burst. And it seems to me that most investors are fighting the last war of deflation, and there's just very little discussion of what I think is a critical chart in this IMF white paper, which shows over the past 120 years, 100% of the time, this works. These sovereign debt levels, when something goes wrong, they all work out the same way, and it's either default or restructuring, or it's inflation of various sizes. And when we're talking about the U.S. Treasury market, default and restructuring isn't going to happen. It's just not. And so the zeitgeist is very focused on the deflationary side. And I think, look, clearly we saw what that looks like for a brief period of time in March, and it wasn't a lot of fun for anybody. And so now I think what's really important is, and this ties into I think one of the really important things that people aren't talking enough about is, for the first time, at least in my career, I've been doing this for 25 years, first time that I can recall, in the sell-off, it was the sharpest sell-off from peak to down 20% in history in U.S. markets. And so it was very deflationary, should be very bullish for long-dated treasury bonds. Long-dated treasury bond yields should collapse, and the prices, which I'm going to use as TLT, the long-dated U.S. Treasury ETF, TLT should just risen and risen as yields collapsed. And initially it did. But then from March 9th to March 18th, something really interesting happened, which was as the market kept crashing, TLT started crashing with the market, dollar for dollar. And TLT went down 20% in 10 days, which should never happen as the market's going down 20% in 10 days. And under this sort of assumed narrative. And so for me, I thought that was a really critical point that is not getting nearly enough attention, which is that because the net international investment position is so unprecedentedly negative for the U.S., foreigners own so many more of our assets than we own of theirs, and because the dollar shortage is so unprecedentedly large offshore, basically every dollar asset that was available that could be sold was sold. And so what we were having was a sharp market sell-off, financial crisis where treasury yields started rising instead of falling because our debt is so high, because our net international investment position is so bad, because the dollar shortage is so big offshore, because the emerging markets are such a big part of GDP. I mean, you look at the emerging markets, first time in 350 years they're the majority of global GDP. First time ever they're the majority of global oil consumption. First time ever U.S. net international investment position is this negative. And so there's these factors that nobody's talking about in terms of trying to gauge or very few people are talking about in terms of trying to gauge the path from here. And if you ignore them, it seems clear we're going to have this sort of deflationary impact for as far as the eye can see. For me, understanding those and factoring those in, it's less clear to me that we're going to see deflation in paper assets and eventually in the real economy as far as the eye can see, just because of what happened in March in the Treasury market and the relative sizes of these factors we talked about before. Sustained deflation, like some are think it could happen, implies that you're going to get a nominal default effectively in the Treasury market and a lot of sovereign debt markets, Western sovereign debt markets more broadly, which, while possible, I just don't believe you're going to see central banks stand aside and let sovereigns default. That's historically not how it's worked. So that was a long-winded answer, but that's how I'd answer it.
A recent tweet. Warren Buffett has often talked about the U.S. long-term investing environment since he began investing at age 10 in 1940, often bashing gold along the way. He's rarely discussed the U.S. investing environment from age 0 to age 10 or how gold did. Is he beginning to consider it? What made you, what was the thought process behind that tweet?
Sure. So Buffett had the Berkshire Hathaway annual meeting, and the tone coming out of it was apparently he was as bearish as people had ever heard him. And he sounded very cautious on the economy. And historically, if you go back to prior Berkshire Hathaway annual meetings and annual reports, one of the things he's talked about a number of times, number one is how useless gold is, of course, but more recently he's talked about in either last year or the year prior, maybe both, talked about how he started investing at age 10, 1940, and it's been a great long-term run, and you know, gold's useless, and what always struck me by that was if you look back to history, that was basically, there's a great book by Barton Biggs called Wealth, War, and Wisdom, and it looks at sort of big cycles and how the wisdom of markets was able to divine that the U.S. was winning the war very early on during World War II. But one of the absolute generational buy points for the U.S. for U.S. markets was in early 1942. Right after the war started, and the markets detected this very quickly. And so Buffett basically started investing within 2 years before one of the great generational buy points. And I just always thought that it was interesting that he never referenced ever what happened from 1929. You know, he was born in August of 1930. So in theory, his parents conceived him right around the peak in the equity markets. And the whole Great Depression, et cetera, those 10 years he never talked about, which is that gold outperformed everything. And most importantly, to get out of that crisis, the dollar was significantly devalued against gold. And that was ultimately a sovereign debt crisis and a massive deleveraging. And so he sort of got in at the beginning of after the dollar had been devalued, after there'd been a massive deleveraging, and before we won the war. And so the fact that he had rarely talked about, if ever talked about that period of time and why gold was really a savior from 29 to 40, 1929, 1940, and then considering that within the context of how he sounded at this meeting apparently made me think, hey, is he actually starting to think, okay, I have to think about sort of when one or more of the four horsemen of the investing apocalypse start to ride for these markets, where do you want to go? And he can bash it all he wants, but there's a reason why it's the quote unquote 6,000 year bubble, as some naysayers said about it a couple years ago.
Okay. Luke Gromen, before we wrap up, can you share with us what Forest for the Trees does and the opportunities your company offers?
Absolutely. So we have two business arms. We have an institutional investment research business arm where we sell research on a consulting basis to some of the world's largest institutional money managers, hedge funds, pension funds, high net worth individuals. We also have a retail arm to our business called Tree Rings, which is a weekly 10 most interesting things list where we put together things we're seeing in the markets and then have quick synopses on each. And that has turned into an extraordinarily popular product. And both of those, information about both of those can be found on our website at fftt-llc.com. For more information, just check that out, and we'll be happy to follow up with anybody if they're interested.
Okay, and I got to ask you about Mr. X interviews. Have you written another book yet?
I have. We got volume 2, and I'm on chapter 3 of 7 of editing. I sent it to the editor. Editor came back with first edits. I'm on chapter 3 of 7, and I am now under the gun to try to bang out the rest of that in the next, get it back to the editor. Once it's back to the editor, again, I think should be down to short strokes in terms of getting it published. So fingers crossed, it should be coming out relatively soon. I know our readers that enjoyed Volume 1 are getting a little impatient, so we're doing the best we can to get that out as soon as we can. The COVID crisis slowed us down a little bit with all the craziness that went on and some of the writing we were doing around that time. But we're hoping to have that out probably in the next few months. So stay tuned.
Okay. Well, Luke Gromen, we thank you for coming on the program and sharing your views and insights, and hope we can do this again.
Absolutely. Thank you so much for having me on. It was always a blast, and would look forward to it.
All right. Thank you also, Luke. Stay safe. That was Luke Gromen, founder of FFTT LLC. For more of his writings on precious metals, please visit his website, fftt-llc.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.